Well, happy weekend, everyone. This is your weekend video edition of Traders Espresso for the week ending Friday, February 9th, 2018. And let's start off by saying it was an interesting week. Um, all the major indices were down, all the major stock indices were down for the week. However, Friday, if you were paying attention, was a good day. There was quite a bounce. There really is no rhyme or reason to why the bounce happened when it did, other than simply the fact that the indices were all in officially in correction territory, and investors decided to step in and buy. This occurred at pretty much the same time for all the indices. So at about 1:30 Eastern time was when you saw the Dow, the Nasdaq 100, probably the composite. I don't have the composite up here. The S&P 500 all rally. The Russell rallied about half an hour earlier than that from its bottom. And again, like I said, the only explanation really is just that these indices were officially in correction territory, and investors thought that it was time to buy, which I think is interesting. I mean, in the face of elevated volatility and with concerns about rising interest rates and an overheated economy, which is what's causing these indices to take their turn, the fact that investors would step in and take that kind of risk, to me, is astounding. I don't know whether these were retail investors or institutional investors, largely. All I know is that that was what was providing support to the market. So if we take a step back and look at all four indices here in this quad, the last one I was looking at was the 15-minute time frame. This is the day chart. Looking at them in their price channels, we can see that all of the indices are now in their price channel. They have closed in their price channel. The Dow closed just above the midpoint of its channel. The NDX, which I think is the laggard as far as its participation in this correction, has finally broken in to the channel and stayed there. It did close here on the 6th, and it broke into the channel, or it actually traded out and then traded back in on Friday, but excuse me, closed within the channel. Same here with the SPX. The SPX has broken into, stayed in its channel. It's now trading in the bottom half of its channel. And the Russell, which has been the most interesting, and I've said it before and I'll say it again, I think the Russell's the one I'm really paying attention to, because just watching its behavior, usually the Russell's the one that leads you into a recession and leads you out of a recession. I'm not saying it's signaling that there's a recession. What I am saying is that the behavior of the Russell tells me that it is the most sensitive to whatever factors are at play in this stock sell-off. So the Russell had broken down to the bottom of its channel. It had closed outside of its channel, and then it rose back up again and closed right on that bottom line. So what will happen on Monday with the Russell anyway is anybody's guess. I also plotted on each of these charts the 100-day moving average and the 200-day moving average, and you can see that with the exception of the Nasdaq 100, all four indices are currently between their 100 and 200-day moving averages. And one of the things I find when I'm trading is that when a stock or a future or whatever it is that you're trading, when it's between moving averages or it's between a series of moving averages, it can then tend to be pretty range bound. The fact that these moving averages are slower, meaning that they're calculated over longer time frames, in this case it's 100 days and 200 days, they tend to be kind of harder lines, harder levels of support and resistance. So it looks like these averages are turning down. My guess would be that as they turn down, the indices that are contained within them are going to drift down with those averages. If they were to cross and close below the 200-day moving average, I think that would be very bearish. I think that we would be in for a pretty bumpy ride. I think we would be going far beyond just a simple correction. Let me come back to these charts. I want to show you RSI, because I've been looking at RSI, I've been looking at the average true range, and focusing specifically on the Dow Jones, and you would see a similar picture with all of the other indices. The Dow Jones has spent so much time above what is considered an overbought threshold for the RSI that the fact that it is finally trading down and into oversold territory is not surprising. But if you think that it's just going to bounce, it's just going to kiss off of that 30 line, I think you're mistaken. Whenever things tend to revert to the mean, very often they overshoot. So I would not be at all surprised if they overshoot to the downside from two perspectives. One is this trading here outside of the price channel. Now that the Dow, and by extension the NASDAQ Composite, and the S&P are back within their channel, I would not be at all surprised if they traded down outside of their channel, like the Russell has already shown it's doing. Even though it didn't break out of its channel, it was elevated above the midpoint of its price channel. So I still think that is meaningful because it was trading in the bottom half of this channel. So it didn't trade outside of the top end of its channel. So, you know, if the Russell is going to mean revert to the downside, I would not expect it to do so as dramatically. I would, however, expect the Dow, the NASDAQ Composite, NASDAQ 100, the NASDAQ Composite, and the S&P to overshoot a little bit, spend some time outside of this channel. That might have the effect of widening that price band or widening that price channel, and then trading back up into it once market action and prices have normalized. So I would not be surprised about that. You can see here over the course of the last year, and this is the Dow again, every time where the Dow was overbought, it was followed by a move in the RSI to the downside, but you can see where these highlighted circles are, it never actually traded down into oversold territory. So there was no healthy sell-off like what you sometimes need. Sometimes you need for the weaker hands to be shaken out of the market before a fresh round of new buying, before a fresh round of new money can come in and start this market up on its next leg higher. So that's kind of the technicals of it. From a fundamental standpoint, I don't think that anything has changed. Rates are still rising in the bond market. The dollar is still strong. It's got 6 consecutive days of gains. It has not, the last couple of days, it did not trade up as strongly as it was in the 4 days prior, because the biggest day was Wednesday the 7th, but it is still trading up. Dollar strength, dollar bullishness is a reaction to the prospect of higher interest rates, because the view, some comments have been coming out of the Fed and concerns about, will the Fed adopt a more hawkish stance? Will they be more aggressive with their rate increases just on their own? They haven't seen, the Fed's been calling for wage inflation for a while now. They finally saw it when the jobs data came out from the Department of Labor. Add to that the fact that a lot of economists were cautioning against passing the tax package because of concerns. They were basically saying you don't need that in an economy that is firing on all 4 cylinders. You're at a full employment economy. Why would you throw fuel on the fire? So there's concern about the tax package adding to inflation and overheating this economy. In addition to that, early Friday morning, the government was officially in shutdown, only for a few hours, because both houses met. They passed legislation. President Trump signed it Friday afternoon, I believe it was. But the thing is that legislation added $300 billion to government spending. Throw on top of that Trump is promising $1.5 trillion in infrastructure spending. Of course, we don't know when that would happen, and we also don't know whether he's going to be successful in getting that passed. But if that were, he's going to fight hard for it, and if it were to come to pass, that would add even more fuel to accelerate the growth in this economy, and that's going to mean higher interest rates. So the overall concern that interest rates and overheating economy is going to derail this market, this bull market, none of that has changed. None of that has changed. In addition to that, we had some geopolitical events occur over the weekend. On overnight, from early Saturday morning, I guess our time, Israeli forces had launched a airstrike against some what they consider to be Iranian and Iran-backed targets in Syria. Uh, Israel has said that they suspect that Syria was responsible for downing one of their F-16s. That was what the reason for their air offensive was. They lost an F-16. And from what I read, the Syrian army also claimed that they downed the F-16. So, there's that tension there. I would expect that to have an impact on oil prices when the futures open Sunday afternoon. The Winter Olympics themselves are not any event as it's impacting markets, but some kind of the geopolitical backdrop behind that I think is important. Yesterday we learned that Kim Jong-un has invited South Korean President Moon to an upcoming summit in Pyongyang after the Olympics resume. And while some people may view that as, a harbinger of peace, or that could be bullish for the markets, I would take a more skeptical view of that, which is it's pretty widely accepted that Kim's charm offensive is really meant to drive a wedge into the special U.S.-South Korea relationship. He would like nothing more than for that relationship to fall apart so that he can form, closer ties with South Korea, maybe even, in his mind, unify the peninsula under the rule of his family. So that tension is still simmering. I would expect that to, if maybe not add to volatility, maybe kind of keep volatility, elevated. Because keep in mind, even though volatility is off of its highs, it is still elevated compared to where we were, almost 2 weeks ago. So we have not normalized yet. The selling, I think, is healthy. I would not really take us, despite the fact that investors came in and bought this market on Friday. I would not be so quick to sound that alarm. I think it's important to be assembling a shopping list if you are interested in individual stocks. If you're more of the ETF index kind of a person, I would take a look at the Russell, the S&P, the Dow, and the NASDAQ in that order. I think the Russell is leading us into this correction. It will be the first one to lead us out of this correction. Again, I think the NASDAQ and the NASDAQ 100 have been a laggard when it comes to so stubbornly resisting moving into correction territory, crossing back into their long-term price channel or into its long-term price channel, and according to the RSI, selling down into oversold territory. It's been fighting that tooth and nail. So I'm not as bullish on the NASDAQ, kind of in the intermediate term. In terms of sectors, I don't know that I think it's too early to recommend particular sectors at this point in time if you look at the sector spiders. But what I would say is there's probably some sectors that you would want to avoid, and those are the ones that have they would be the last ones you would buy into, because those are the ones that up until this point have avoided really trading into an oversold condition. They've been fighting it. I would avoid, and those particular sectors are technology, healthcare, financials, and consumer discretionary. Those 4 sectors have been avoiding going into oversold here. They've been kind of flirting with it, but they've just bounced right back out again. And the fact that the average true range, if you pull up any of these charts, average true range, other than this little leg here, this little crook, ATR has not been pointing back down again. So that is going to have to happen, or at least give the hint of happening, that we're normalizing, because these price swings that we've seen have been tremendous. The Dow, over the course of the last, week or so of correction, traded up and down, if you accumulate all that, like 22,000 points. That's almost the entire value of the Dow. Now, I'm not saying it went down 22,000 points. It went down 1,000, went up, 500, and then it went down 1,000 again, or 800 again, whatever the case may be. You take all those swings and you add them up, it's 22,000. So volatility is still elevated. I'll leave you with those thoughts to contemplate going into the weekend, and we'll see how things shake out come Monday morning. It should be interesting. All right, thanks for watching, everyone. Have a great week.